What's up, investors? On this video, I'm going to talk about the four major places that we see a lot of our investors will harvest capital to start investing in real estate or some other syndication project. So I'll start off with some of the high level. First, we need to begin prioritizing our investments or cash holdings and going after those that are hitting the lowest return on equity marks. And this strategy is what I call the low return on equity witch hunt. It goes in this order as follows. The first thing to get after is the net savings from our income minus expenses. Basically, what you make at the end of the year after all your normal expenses. For most of the people within our community, they're saving $50,000 to $100,000 at least. That is probably just enough for a syndication deal or two. Now, this initial focus should be on deploying the net savings accumulated each year. For those of you guys who are overachievers, run these things to our credit investor banking or infinite banking system, loading it into a whole life cash value, low fee type of structure, then taking it right back out in a loan, then investing it in a deal. If you guys want more information about this, check out our free e-course at thewealthelevator.com/banking. This is kind of your first source of money to start to go into alternative investments. The next thing to go after is your cash on hand. Although it's advisable to maintain some of the cash savings in your emergency savings, what we find is you guys out there don't really require too much in terms of cash. Most of you guys out there doesn't really need too much cash on hand unless you own your own business, which then you might require some higher cash reserves to pay for things like payroll for your staff. Typically, if you don't own your own business, enough to float your credit card bills or 10, 20, maybe even $30,000 in your bank accounts. A side note, again, a lot of our investors will use their credit investor banking, infinite banking as a secondary liquidity source, just in case they want to add a little bit more padding into this cash savings and then make nice yield there and off the table litigators. Now, the third source is the lazy equity in your home. Most investors focus on utilizing home equity in their primary residence. This equity can be accessed through a few main options. So first, the HELOC, next is the cash out refinance, and then third is selling the property and potentially transitioning to renting, as I did when I first started to invest in real estate, which is actually how I turbocharged my investments. I was able to save almost $100,000 every single year to put to buying more and more properties. Now, the first thing that, again, most people will do to test the waters with this is a HELOC, a home equity line of credit. By pulling money out of your primary residence, you're able to use this attractive option as it incurs minimal fees and only charges interest on the money drawn through simple interest. However, it may not grant access to the whole equity of the house. And if you think about it, a lot of the HELOCs, you may only be able to get 80% of the value that's in there. 20% of it you may never get. But nevertheless, this serves as a convenient starting point for new investors to start to deploy some of the funds. If you've got a $600,000 house paid off, you probably could easily get access to half of that 300 grand. And that might be able to get you into several deals. That may even be able to get you through your first couple years of investing right there before you start to have to do what comes next after the HELOC, which is to refinance the house. At this point, you're incurring lender fees. Now, the good thing about a cash out refinance, it allows you to take your leverage up to the maximum allowed, normally around 80% or maybe even more. This allows you to access a greater portion of your home equity. It's worth noting that cash out refinance involves associated fees. Beware of those mortgage lenders out there telling you that it's a no fee loan. What they're really doing is increasing that interest rate very slightly and then compensating their fees that way. It's one of these switcheroos that's out there, and why we think take the HELOC as far as you can because there's no fees associated there. And then when you're getting a more and more amount, do the cash out refinance at that point. Or as the last result, a lot of investors who've been doing this for several years now, they get it, see the light with investing in alternative investments, and they realize, let's just sell the house. And this can be a great strategy if comboed with your downsizing or you're going into a different location, maybe moving around school districts. I always say, especially if your net worth is under $1 million, $1.5 million, maybe really start to think about pooling a lot of this equity, and rent's not a bad idea, especially in the markets that a lot of you guys will live in, high price areas such as Washington, Hawaii, New York, even Dallas these days. Probably is better to not put down the down payment in your house, but to invest that elsewhere and then pay rent in somewhere that you like to live and probably in a better area than you could afford. Now, once you've gone through the home equity, again, we like to use the home equity first because in theory, it's just going up with the pace of inflation. The last area that we were going to go after is the qualified retirement plan money, which falls under the category of all 401ks, these 403bs, TSPs, IRAs, Roth IRAs, these types of plans, also traditional investments, and also those that are in the traditional IRAs too. Now, when I was starting out, I pulled the goalie in terms of my IRAs and Roth IRAs, and I'm glad I did it because when my net worth was lower, I really needed that concentration to go buy rental properties, to get into real estate, so I could get tax benefits that really benefit you to grow your net worth in the beginning. Now, sure, later on, when you get to the third or fourth floor of the wealth elevator or get your net worth past $2-3 million and above, it's nice to have these qualified retirement plan tax sheltered accounts. But as we discussed in other videos, and you can check out at thewealthelevator.com/QRP, I talk a lot about in detail why these retirement accounts are advantageous for sophisticated investors, especially investors getting the tax benefits and depreciation that they would in real estate. When you're investing through a qualified retirement plan, you're getting the tax benefits, but it's staying insulated in your retirement plan and not helping you on your personal taxes situation, which is what we want to maximize. That's one of the reasons why going after your qualified retirement plan money is one of the last options we go after. A lot of our clients are in their 40s and 50s. They've done it the traditional way where they're told to put money in their retirement accounts to other QRPs. We see a lot of investors doing it. You also got to keep in mind when you take money out of your 401k or your traditional IRA, you're essentially taking it as an income. So your AGI, your adjusted gross income, may be going up that particular year. So there's needs to be some personal finance care in terms of where you are in the tax brackets. This is where it gets into personal finance, something I really enjoy helping people on. You can check out the multitude of different coaching calls that we outline based on net worth levels. Go to thewealthelevator.com/coaching and find where you are in terms of net worth levels. And you can see what we're talking about. From time to time, this topic will come out of taking money out of people's retirement accounts. And then where will that put them in terms of the tax brackets and strategically how much they would like to put out. We mentioned 4 areas to take liquidity out and redeploy it into alternative investments. Every situation is a little bit different, and sometimes things can get rather complex where somebody is taking maybe $100,000 out of their retirement accounts and $200,000 through a HELOC or cash out refinance of some of their primary residence or the rental properties that they already own. But yeah, that's a little overview. Major sources of capital we see our investors pull from to redeploy into alternative investments. Why do they do that? Better returns. But I think the big thing is the tax benefits that it provides. See some of our other videos at thewealthelevator.com/tax to see how the wealthy mitigate their taxes in that way. What we try to do here at the Wealth Elevator is create a process to move from traditional investments to alternative investments in a structured manner over the course of several years. Check out some of the coaching calls that we have also on this YouTube channel. If you guys need anything, join our club, thewealthelevator.com/club, and book a free onboarding call with myself, and let me see how I can help out.